Okay, the first topic I'm going to go through with you today is incorporation of sole traders, partnerships and limited liability partnerships. So first, let's just have a look at what is a business incorporation. Well, basically what it involves is a transfer of a business and assets to a limited company, and it can be done by a sole trader, a partnership or a limited liability partnership. And the transfer of the assets, that is a disposal for tax purposes. Hence, you've got to and you need to manage the consequences that comes along with it. The next important thing is, why do a business incorporation? Okay, why would one want to do a business incorporation? I think the first, probably the main reason why one would want to do it is because of the tax rates. If you look at the high income tax rates, the capital gains tax rates, compared to the much more favourable corporation tax rates that we have now. Other reasons you can look at why one would want to do it: inheritance tax planning, succession planning, trying to get assets like out of your estate and do some sort of estate planning. You've got your corporation tax reliefs. That's another reason why one would want to do a business incorporation. And even just for commercial reasons, like the risks which are more attached with sole traders and partnerships compared to like companies. Okay. We need to think about what taxes, what issues are involved around doing a business incorporation. So just briefly looking at, we've got income tax issues like for sole traders, partnerships, looking at their cessation period, looking at any losses, looking at the capital allowances, any overlap relief issues, so you need to consider those. VAT, well, it will be a transfer of a going concern, the business incorporation, so that's outside the scope of VAT, so you don't need to worry about that. If you've got land and buildings in your business, and that's going to be part of the transfer of your business into the company, then there are issues that needs to be considered there. Stamp duty, land tax. If you are a sole trader and you are incorporating your business, then and you've got land and property, then yes, there will be stamp duty, land tax, and it's on the market value of that land at the time of transfer. If it's a partnership and it's doing a business incorporation and it's incorporating, then there's actually a special provision within the partnership legislation whereby no stamp duty, land tax will be applicable, so you can come out of the stamp duty, land tax provisions there. The main issue that I want to talk to you about is the capital gains tax, because when you're doing the transfer of the assets, that's a disposal for capital gains tax, and how can we overcome the capital gains tax issues? And there's two major reliefs which are available here. The first one is the incorporation relief under section 162 of the Taxation of the Chargeable Gains Act 1992. This is a mandatory relief. No claim is required as long as you need to satisfy the conditions, and then you're in it. You don't need to make a claim for it. How does the legislation actually define a section 162 incorporation relief? So I just want to look at that. So section 162 applies where a person who is not a company transfers to a company a business as a going concern, together with the whole of the assets of the business, or together with the whole of those assets other than cash, and the business is so transferred wholly or partly in exchange for shares issued by the company to the person transferring the business. The main point really in that part of the legislation that you need to pick up on, that is where it talks about a business. You're transferring a business as a going concern. And I think that is the beauty about this relief, because it's not just a trade, okay? It can even include like investment related trade. So like, if let's say you've got a property portfolio, so land and buildings. So it is quite quite broad in the sense that it doesn't just include trade, it includes other businesses as well, especially investment related businesses. So just in summary, how does this relief work? So let's say you've got your business, you've got your assets, you transfer them into the company, so you're incorporating them, they go in at market value. Okay, and in exchange, you're receiving shares, and it could be any type of shares. So not just ordinary shares. You could receive preference shares. You could receive redeemable shares in exchange for it. Now, when the assets go in, they go in at market value. So the gain on those assets gets rolled over into the shares. So now your shares are pregnant with the gain, not the assets. Okay. And another, I suppose, a good point about this relief is that when you're transferring it to a company, the company does not need to be a UK resident company. It could be a non-UK resident company as well. Okay. And I suppose one of the common incorporations that I come across as part of my kind of day-to-day job is where I use a section for clients where they've used a section 162 is on a property portfolio business. So let's say, for example, you've got husband, wife, they own a whole load of properties, they've got a property portfolio, and these properties are, let's say, pregnant with gain. Okay, a bit of planning point here. They could use section 162 incorporation relief. They could incorporate that business, so transfer the properties into the company, and that will be done at market value. In return, they would receive shares for those. In exchange, they would receive shares, and those shares, let's say in this case, will do redeemable shares. Okay, and now the properties will sit in the company at market value, and they've got the shares. Any tax consequences? Well, for VAT, it's a transfer of going concern, so no VAT issues, it's outside the scope. Stamp duty, land tax, it's a partnership that's transferring, it's a partnership that's incorporating their business, because husband and wife, they own the properties jointly, so there's no issues there, because under the stamp duty, land tax, you've got the special provision where it's exempt. And capital gains tax, where you're covered under the incorporation relief, so no capital gains tax. Okay. And it just gets even better because your properties are now in the company, they're being transferred at market value, they're not pregnant with gain anymore, so if you wanted it within a couple of months to sell those properties, you can sell them and there won't be any gain because they wouldn't have gone up hopefully within a month or two. And then when I said that in exchange you'll get redeemable shares, or it could be any type of shares, but let's say we went for redeemable shares, later on you can try and extract the value out of the company by redeeming those shares, and you can do it such as a planning point, you can do it so that you can only redeem that level of shares up to the value of your capital gains tax annual exemption, which is 11,000 at the moment, and you can do it such that you could do it in tranches, so you can do it up to the level of the annual exemption and not pay any tax. Okay, so that's another tax-free way of getting the income then afterwards out of the company. So that's the one relief which is available, the incorporation relief. The second relief I mentioned, or I was going to mention, is the gift of business assets relief, which is under section 165. Just briefly, I mean, this is basically where individual assets, so the sole trader partnership gets their individual assets and they are transferred into the company, and both the transferor and the transferee need to make a claim jointly for this. And here the gain gets rolled over into the market value of the asset when it's sitting in the company. Okay. But this is a bit more restricted because it only relates to business assets. That's only when you're gifting business assets. And just another point on incorporation, which is quite common, is goodwill. Okay, you've got two options really for goodwill on incorporation. And the first option is the sole trader or the partnership, they can sell their goodwill to the company for a consideration. So they'll pay capital gains tax. It will be at the rate of 10% because you can claim entrepreneurs relief, which I'll talk to you a bit later on about. And then provided that the sole trader and the partnership started their business post April 2002, because that's when the intangible legislation, the new rules came out, it can actually claim a corporation tax deduction on the amortization of that goodwill in the company accounts. So it's able to do that. So that's a benefit there. The other option you've got on goodwill is to make use of section 165. If you don't want to sell the goodwill to the company, then you can gift the goodwill to the company and do it via a section 165. So you're gifting that goodwill to the company and pay no CGT that way.